Whenever you're investing in a fund, it's always good to look at what is the cost and also what am I netting from all these. When I'm investing in a money market fund, I do not have the pressure to keep on thinking which treasury bills are in the market right now, which fixed deposit do I have to buy into. I am having the fund professionally managed by a fund manager, and I don't have to have sleepless nights. So you find for any fund manager, not just Mansa X, you do not guarantee returns because the returns are always determined by what is happening in the market. And when you look at past performance for Mansa X, for instance, we've consistently delivered a net of 18%. And this is all what we have delivered, but we do not promise the investor, like this year we are going to give you 20%, 30%. It's all about what is happening in the market.
Hello, welcome to another episode of Make Money the podcast. And as always, this is a place where we not only tell you, but show you what's happening to your money and what could happen. And of course, we are always guided here by conversations with the experts of money. And I'm happy to introduce our topic for the day. We are talking about something quite sensitive in fees. Think about it. Every time you invest, you always think of the return you're going to make. It's always mostly about the return, what's the percentage, how much will you be making of your money invested. And we don't really put to mind a lot about the fees that go along with that, be it transaction fees. You have a bond levy when you're buying bonds. You have an equity levy when you're buying equities. And if you're in the investment space through funds, then you have fund management fees that incorporate other aspects like performance fee and whatnot. And so we are happy to have that sensitive conversation right here today. And again, I'm happy to introduce my guest for this week. And this is a senior relationship manager for global markets at Standard Investment Bank, Miss Lydia Muriuki. Welcome to the podcast.
Thank you, Kefa.
And like I said, from the top right there is quite a sensitive topic, especially talking to you. You work for a fund manager in effect. And there are some fees that go along with investing. And today we really put these fees under the microscope to try and have an understanding of why those fees exist, why they matter, could they be lower or not. And happy to have you here, of course.
All right, thank you. Thank you, Kefa. It's a pleasure to be in this bench.
Great to have you, Lydia. And I'll go right at it to talk about fees and most of the fund management fees. So let's take an example of 100,000 shillings in a money market fund. A fund manager will ask for 2% of these. So this is effectively 2,000 shillings. And that, of course, is usually netted by the time you're getting your return at 15%. It's factored out that you paid 2% in management fees. So let's talk about these fees. And are they, in a sense, fair? Someone might feel, 2,000 shillings on 100,000 shillings might be high depending on the return I'm getting and whatnot. Is it a fair cost?
Whenever you're investing in a fund, it's always good to look at what is the cost and also what am I netting from all these. If you look at a client who is investing in a money market fund and they're paying 2%, that is quite a very fair rate. The market average allows between 1% to 3%, and this is justifiable because you find when I'm investing in a money market fund, I do not have the pressure to keep on thinking which treasury bills are in the market right now, which fixed deposit do I have to buy into. I am having the fund professionally managed by a fund manager, and I don't have to have sleepless nights. So they give me the peace and the comfort as I practice and do what I do best. I know somebody is taking care of my money in a professional way. So I think the cost is quite justified, and it lies within the allowable industry standards.
The standard fee charge is around 1% to 2% for most fund managers and most funds. But let's move it a notch higher and talk about the special funds anybody who's interacted with the Business Daily, we had an analysis not so long ago around the fees charged on special funds. And what you tend to see is you have a performance fee. Sometimes you have some withdrawal fees depending on the type of fund. And the base is much higher. It's not your usual 1-2%. You go up to sometimes 6%, 7%, depending on who's offering this fund manager. Now, of course, it's important to note that these funds are also offering you a higher return more than, what is the traditional, maybe say 10 to 15%. Some of these funds are able to produce returns of over 20% consistently. So when we are thinking about the higher funds for the more sophisticated type of fund, are they also fair in a sense from what they're able to deliver?
Now, when you think of special funds, maybe to refer to a fund like Mansa X by Standard Investment Bank, they charge a 5% management fee. And the reason as to why this fee is justifiable is, first of all, you find we are looking at a global outlook. So we are giving the investor access into spaces they might not be able to access as an individual. You're thinking of you can buy derivatives, you can buy global stocks, you can buy the currencies. It's a very diversified fund, and with these, it requires a very high level of specialization. So the fund manager, the traders, the researchers, they need a higher level of expertise as compared to a money market fund, because they are looking at a global aspect. And also we have to form global partnership, not just local. And as a result, you find that this requires a higher fee. But when you look at it, the fee is justifiable, because at the end of the day, the special funds are able to deliver a return that is higher than what the money market funds are giving. And for Mansa X, we also have a performance fee. But a performance fee is based on whenever we reach the hurdle rate, where in this case, the hurdle rate is 25%. So if the fund manager is able to give you a return of more than 25%, whatever is on top, you share with the fund manager. So it's a win-win. And like for Mansa X, the performance fee is 10%. So if we do 30%, this 5% you're going to share with you. Where as an investor, you take home 90% of the 5%, and we take home 10% of the 5%. So it is a justifiable fee. And as you can see, we've been able to give the investor a fair value for their money. And also, when also you look at the investor we are targeting for the special funds, they have an entry barrier. So we are looking at an investor with a high net worth and with a minimum capital of 250,000. So it's a whole investor who can hold their money for up to 6 months without really thinking of it. So it's a different type of investor.
Your level of sophistication, depending on the fund, then will sort of align with what the fund manager is asking for. So does it mean perhaps if you needed 1 or 2 analysts for a money market fund, you could be needing 6 or 8 for a more sophisticated fund, maybe offshore? Is it the way it works here?
I would say it's more about the skill. So when you think of a type of skill you require for a manager who is running a special fund versus a money market funds, these are two different types of skills. For the special fund, they require traders, analysts, who have a whole global aspect. So they need to understand which are the commodities, which are the asset classes in these global markets. Whereas when you compare with the money market fund, it's more of investing in the local asset classes. So it's buying the treasury bills, the fixed deposits, so they do not require a higher level of sophistication in terms of their skills.
A lot of the times, like we mentioned, people really focus on the return when they are looking at where to invest. And a lot of times someone will pass by you and tell you, I'm trying to compare one investment from the other, and I'm seeing this fund is paying 15%, this other one is paying 12%. And you can see the inclination towards the higher paying fund or the higher paying asset class in a sense. When we come to fees, do you get the reverse now, where someone is focusing now on the fees, where, you know, a client will come to you and be like, this 1% management fee, I'm seeing the other one is 5%. Maybe I'm more inclined towards 5%. Are investors really giving a thought to costs, the cost of investing? And would that, in a sense, ever be a hurdle to participation, especially by retail investors?
Of course, that is always a consideration. And sometimes you find there's an investor who is going to be, why are you charging me 5%? Whereas I can pay 2%, or I can do this directly by myself. But you always look at what is the net return. And actually we always focus on, I could be charging you 2%, but I'm giving you a return of 10%. I could be charging you 5%, but I'm giving you a return of 20%. So you find it's justifiable depending on what is the actual net. What am I taking home? What is in my pocket as an investor at the end of the day?
You did mention the role of the higher fees in terms of enabling the infrastructure, where you have an analyst with a global view, maybe a couple of them and not one in some cases. Mm-hmm. So meaning this justifies then why you would be asking for 5% and not your 1 to 2% average. So let's come to people who think if they just go and buy something offshore, well, I might as well go and do it. You know, there's that perception that why should I be paying fund management fees? Well, maybe I can invest directly myself. What would you say to someone who challenges that? I can also go and buy NVIDIA out there myself without needing that expertise. What's the difference between investing through a fund like yourself, what you run at SIB, versus me attempting to maybe move around my 100,000 across portfolios to try and get to the same return as a fund manager would deliver?
First of all, you find when you invest in a fund, your exposure is covered. You're not overexposed. Of course, you can go and buy NVIDIA by yourself, but how about if NVIDIA tomorrow dips? When you invest in a fund, we are not just looking at NVIDIA. We are looking at NVIDIA, we are looking at Microsoft, we are looking at Oracle. So like for Mansa X, at any particular time, we spread the risk in over 200 asset classes. So what this means is when some are going high, others are going low. So you're still covered. And also because of the level of specialization and the skills our traders and our fund manager have, we are also able to employ complex trading models like the long-short trading model. Whereas for you, as like Kefa, you can now not be able to employ that because it requires a higher level of skill and sophistication. Then the other thing is, of course, you're doing the market research for you. So we are always following the trades to understand what is happening in the market. And the fund is actively managed, so we are able to switch positions. Whereas you could buy a stock, you don't understand what is happening, then the next minute you hear something has gone amiss. So when you invest in a fund, you're protected from the downside risk because now you're pulling your money together and the risk is spread across different geographical locations, different asset classes. Some are not related. But if you go and invest by yourself, you're limited by the capital you have. If you think of, let's say, an S&P 500, it's over $6,000. So how many can you buy of that? So investing in a fund now gives you access to all of these asset classes, whereas you're covered because of diversification.
There's something I really like with what Mansa X does in terms of what I would call your fund's prospectus or your fund details. You always tell investors that past returns are not indication of future returns. And here we come to, we segue this conversation to the point where there's expectation from clients that a certain fund, let's go even outside Mansa X and think of any other special fund out there in the market. You've consistently delivered 18, 19, 20, sometimes we've seen 20, 23, 24%. We know the fees in this case are much higher than your traditional 1 to 2%. So maybe you are sitting at 5, 6%, but it becomes almost engraved into the minds of an investor that, hey, I can always expect 18 to 20%, every year as a bare minimum. Do you feel that ups the pressure on fund managers like yourself sometimes, that even though you've let clients know openly that, hey, our past performance is never an indicator of our future performance, but because you've delivered so consistently, people tend to expect a certain kind of returns with funds like yourself, with what you have at Mansa X, and we do know we have quite a number of special funds that would, be attracting the same kind of fees, but also delivering the same level of returns here.
So you find for any fund manager, not just Mansa X, you do not guarantee returns, because the returns are always determined by what is happening in the market. And when you look at past performance for Mansa X, for instance, we've consistently delivered a net of 18%. And this is all what we have delivered, but we do not promise the investor, like this year we are going to give you 20%, 30%. It's all about what is happening in the market. However, as a fund manager, of course you feel you have a responsibility to deliver as per the expectations. Though we do not make promises, but we always aim, any fund manager, they always aim to give the best return to the investor without overexposure. You can be under too much pressure where maybe you may overexpose trying to get a higher return, and then things may not go as expected. So we always try to be very conservative in terms of even how we invest. And when you look at even in terms of our asset allocation, we do not do a lot of very high percentage into one asset class, no matter how good it's performing. So you find as a fund manager, you have to think and have a balance between the return to deliver and the risk you're going to expose your clients' funds to. So you must always create that balance. Don't promise of what you're going to do in the future, but also you're being paid a fee and the investors have an expectations. So that is why we always share performance updates. We share where we invested like the previous quarter. We also share outlook on what are we looking at the next quarter. So it's all about transparency and being very open to your investors on what is happening in the markets.
Let's now move on and talk about the performance fees. And something of interest here, it's quite a scenario one creates in their head that if a fund performs past a certain level and you've exceeded expectations, there's a performance fee that you get to share of what's over and beyond where the hurdle is set. Effectively, that can be set anywhere depending on the asset class. Say For your case, that would be 25%. So whatever is above 25% is shared out between the fund manager and yourself. Someone interested me once in a thought and said, if we have a performance fee, should we think about some sort of discount whenever maybe, again, like you said clearly, you do not promise any level of returns, but somehow consistently you've delivered a certain level. There's a certain sense of how much return you'll be getting into any investment for that matter. From a fund manager's perspective, would it be fair maybe to discount fees maybe on a bad year? Would it ever make sense? Is there a case for that? I know you have salaries to pay. You have analysts, like you said, and you already put the obligation on them to be watchful of all opportunities across the globe in a sense. When it comes now to a year where maybe, like you said, the average for yourself has been 18%. Let's say a year you do 5%. This is again just something we've made up here.
Yeah.
You've made 5% and someone feels, hey, maybe this year instead of over and beyond the 5% fund management fee that I do pass on to you as my fund manager, maybe you can discount it to 3% for that bad year. Would there be a case or scenario where that can be the case?
That's a very hypothetical situation, and I hope it never happens. So when you look at the management fee or the financial charge, that is a fixed cost. And it is more non-negotiable for most of the fund managers. Though just saying we've never had such a scenario, maybe should such happen, who knows, there could be considerations. Because when you think of it, running a fund is like a business. And when you're running a business, there's already the cost that you already know this cost is fixed. We have offices to pay, we have salaries to pay, we have research to pay, we have all these brokerage fees that we pay. Remember, like for instance, when you're buying stocks, you pay a fee that is based on the transaction. So whether you're making money or you're making a loss, whatever you're paying is a fixed fee. So for the performance fee or the management fee, that one is a fixed cost. Now we put a variable based on the performance fee, whereby if we do more, if we give you a better return, you also feel rewarded by the performance charge. But now for the management fee, it's a bit of a fixed cost because we have all these other costs that we need to take care of.
So to cap off this conversation, I would like you in closing to kind of give us a view of what should we be thinking about when we look at fees, vis-a-vis, of course, expected return and net returns. And that interplay, there's quite the interplay between fund management fees and expectations on return or the return expected. How should an investor think about fees? When I come and see a fund is asking for 5%, they've consistently delivered maybe sometimes even over 20% in a year. Sometimes even it goes well over and beyond the performance hurdle rate, and we see 30-40%. And we do know, of course, your traditional funds are much lower at 1-2%, but you're conservative again in how much you can expect in returns, maybe in the single digits mostly, sometimes double digits, depending on your interest rates are. Coming back to the question here, as an investor, how should I be thinking about the fees I'm being asked for, the fees I'm having to part with as an investor, vis-a-vis the expected and the actual return that comes to me?
So of course you have to think, at the end of the day, as an investor, where am I? You see, when you look at a special fund, it's not accessible to anyone. So if you don't have the minimum, you first have to start with where you can afford, which maybe might be in a money market fund. And you look at the money market fund, you look at what are they offering at the end of the day? What is the net return that I will get as an investor? Let's say you have the option of a special fund and a money market fund. You have to look at, I'm paying 5%, I'm paying 6%. Is it justifiable? What am I taking home at the end of the day? So you have to look at the fee, but most importantly, what you need to look at is what is the net return. If the 6% is justifiable, then, and you're able to do a special fund, of course, it's going to offer you more return, as well as it's going to offer you a more access to more asset classes, to the global markets and all that. You find that I would be able to invest in this special fund because I have the money, or I am at that level where I feel I need to access the special fund. So most importantly, as an investor, whenever you're looking at where do I invest, you have to think of the end goal. How much am I making? What am I taking home at the end of the day? You could be charged 2%, but you're taking home a 1 digit. You could be charged 5%, but you're taking home double digits. So always think at what is it in it for me when all is said and done. And actually at Mansa X, we always emphasize more on the net return as compared to the gross return.
Thanks for that. And that has been Lydia Muriuki. She's a senior relationship manager for global markets at Standard Investment Bank. And my name is Kefa Muirore, and that has been another episode of Make Money, the podcast by the Business Daily. And until I catch you on the next episode, remember, as always, make that money work for you.